Okay, so direct materials, we know how much we need. We know how many units we're going to produce. We know how much material we need. Now we need to buy it. So let's find out how much we're going to pay for this. It's 40 cents per pound. One half of the month's purchases is paid for in the month of purchase. The other half is the following month. The March 31st accounts payable balance is 12,000. Let's play our game. So we start with 12,000 accounts payable for April, and we add the April purchases. April purchases were split between paying for half of them in April and half of them in May. So as we can see here, April purchases of 56,000. That's 50% of the 112,000. Where did we get the amount? Well, it was 140,000 that we needed from the previous production budget, the materials budget, and then it's at 40 cents per pound is $56,000 total for April, and of course we pay for it with 28,000 in April and 28,000 in May. So the first step is the amount of pounds multiplied by the dollars per pound gives us the total of 56,000, and then we split half of that into April and half of that into May. So our April is 12,000 that we already owe, plus the 28,000 for half of the purchases during the month of April. So our April cash outflow or disbursement is simply the two added together for a total of $40,000. You can see we do the same thing in May. We do the same thing in June. Of course, June, we're not paying for all of it. We're paying for half of it this quarter. And then July, that will be the accounts payable future balance for this in July. So we only pay for half of it in June. So the total here, and these totals are easier to multiply across and vertically. You just add them across and add them down, and you end up with $185,000 cash flow that's going to be going out for direct material purchases. This is going to obviously tie into our cash flow statement at the end. So we now have a production budget. We know how many units we're going to produce. We know how much direct material we're going to use, and now we know how much that direct material is going to impact cash flow and when we're going to pay for it. So now we've got direct materials out of the way, we can move up to direct labor.